Now let's go on to the next set of visuals, and these visuals are very specific to the age of the child. So there's three different visuals. There's one for 17 and under, another one for 18 through 20, and 21 and over, because there's slightly different tax treatment for each age range, right? So the most beneficial, and if we know clients have kids that are 17 or under, that's the target that we want to hit. This is where the client's going to get the most tax benefits if they're able to pay their kids through the business. So let's go through the first one for paying the kids that are 17 and under. So in this visual, this is I guess the math visual. So after we give the broad overview where we went through the who, what, why, when, this is where we actually go through the math. So letting clients know exactly how they're saving on taxes. So I like to use this visual right here. So the top section just goes through the actual math for what the parent's snapshot would look like. So it would be, okay, the business, if you look at the graph right here, the business shows normally $100,000 profit. And let's just say they don't use this strategy. Like the business owner has kids, but they decide, I don't want to go through the hassle of going through payroll. I don't want to go pay my kids because my kids maybe they're lazy. Maybe they don't want to do any work, so they can't hire their kids. So this is what it would look like, where if they have $100,000 profit and the taxes that come with it. So on the left side, by not using this strategy, they're going to pay this much in taxes. So it's like the federal tax, the SC tax. So total tax here in this example is going to be $21,205. And now we use the other example. Now let's say this guy uses the strategy where he does have a profit of $100,000, but now he paid his kid $15,000, so that lowers the profit, and now his profit is only $85,000. So taking the taxable amount of $85,000 with the taxes involved, which with federal tax, SC tax, that means the total tax that he's paying is $17,412. And you can see there is a difference in tax savings just by paying the kid $15,000. So the tax savings here is $3,793. And to me, that's a big tax savings, because if this client who's a business owner is already paying their kid, maybe they're funding their kid's 529 account by $10,000, and then throughout the year they do give the kid a $5,000 allowance. Well, that's $15,000 that they're already paying out of their own pocket that they never got a tax deduction for. But now when we utilize this strategy, they get a tax deduction, a big tax deduction that's going to save them $3,793. And remember, this is per kid. So every kid that they have that is legitimate, that they could work under the business and do real work. And I'm going to go through more details because you're going to hear me keep on saying legitimate work, because that's going to be an important factor, is that every kid is going to save them $3,793 in taxes if they're already spending $15,000 per kid, which I'm pretty sure most parents could say that $15,000 is not that much when it comes to raising a kid, especially maybe a teenage kid, right? So this is a great way to move expenses that you're already paying for the kid into a legitimate business expense and get a tax deduction for it. Now here's the kicker. On the lower part of this visual is where we explain to clients, okay, well, the business got a deduction for it and paid the kid. Now, doesn't the kid have to pay taxes on it? Isn't that income to the kid? No, because we're going to pay them under the threshold. So for it to be not taxable to the kid, we have to make sure that the amount received from the kid is less than the standard deduction amount. And for 2025, the standard deduction is like $15,000. So you could pay the kid up to $15,000 and pay zero taxes. Zero taxes. And in this visual, this is where we're going to talk about why the kid doesn't have to pay taxes and the rules that we're going to make sure that we meet for the clients to avoid any taxes for the kids. So on this part is that there's no federal income tax, because the rule with federal income tax is that as long as there's a filing threshold, right? So, and usually the filing threshold is a standard deduction, and the old rule was if there was an exemption, you add those two together. But in this case, for 2025, as long as the amount received as income is less than $15,000, then normally the the person doesn't need to file a tax return because it's under the threshold. So anything over $15,000, that's when they need to file a tax return. So in this case, we're just going to pay the kid just enough to be at the threshold or under, so they don't have to file a tax return, and that means they don't have to pay taxes, because you only file a tax return if you normally have to pay taxes, right? So in this case, the kid doesn't have to pay taxes, so we got that. Now the next thing is Social Security and Medicare tax. Now, as a Schedule C business owner for your client, they should know that they're already paying Social Security and Medicare tax on any of their profit, right? And they should also know that if they hired anyone else outside, like a stranger that's not their kid, even a niece or nephew, if they hired someone that's not their kid, well, that other person's going to have to pay Social Security and Medicare tax as well. In this case, there's a special rule that IRS has when it comes to Schedule C owners, and they are hiring their own dependents. So if they're hiring their own dependents and they're age 17 or less, then they avoid paying Social Security and Medicare tax. So this is a big deal because that's 15% alone on pretty much any of the income received. So by paying the kid one under the threshold to file tax returns, but also because they are dependent of the Schedule C business owner, they avoid Social Security, Medicare tax, but they also avoid federal unemployment tax at the same time. So let's say that your client actually has a niece or nephew that is 16 years old and they want to hire their niece or nephew. The problem here is that because that niece or nephew is not a dependent of that business owner, well, when they pay that niece or nephew will report Social Security and Medicare tax on that income because they're not a direct dependent of the business owner. So very important distinction to know that this only applies to dependent kids of the business owner. So clients should know that if they have dependent kids, that they could apply this rule to each and every kid. But clients should also know that if they pay their kid over that standard deduction amount, so let's just say the standard deduction amount for 2025 is $15,000, and they pay their kid, say, $20,000, well, the amount that's over $15,000, that's going to be taxable. So the first $15,000 is not taxable, and then from $15,000 to $20,000, that $5,000, that's going to be taxable, and that's where it still could be beneficial, and we'll talk more about it later. Well, actually, let's talk about it now. It could be beneficial if they paid more than the standard deduction because the child's tax rate is still way lower than the parent's tax rate. So if the parents are already paying more than $15,000 for any reason to the kid, like maybe they wanted to super fund a 529 plan or something like that, well, this is a great way to still pay more to the kids, get a tax deduction at the higher bracket at the parent's rate, and the kid will just pay whatever tax at the lower rate that they have. But of course, my advice is to always try to stay under the standard deduction amount because especially for kids 17 and under, paying them more than $15,000 is kind of excessive for a kid that's 17 years old, 16 years old, because making that kind of money as a 16-year-old is not very common. So we'll have to, and we'll go through that a little later too. We have to determine what is a reasonable amount to pay the kid. And another kind of warning is that be aware of your state income tax because the federal standard deduction, that $15,000, is higher than a lot of state standard deductions. So say for California standard deductions, I think is like $6,000 or $7,000, while the federal is $15,000. So what happens is that when a client pays a kid $15,000 and they're under the federal threshold, so they're not paying anything for federal, but because on the state side, it's over the standard deduction threshold for the state amount, they're going to end up owing on the state side. So for California, they usually end up owing like another $200 or $300 in state taxes. Now,